Ready to elevate your credit understanding and score? With insider tips and a plan, you can take action to improving your score, which can save thousands in unnecessary finance charges. Let's tackle today's topic with your coach, Credit Christy.
Hey friends, it's Christy, your credit coach. Thank you so much for joining me for another episode. Today, let's answer the question, why would my mortgage loan application get denied? So why am I starting off with this question? Because the answer has to do with credit. That's right, friends. Across the board at so many different places I had gone to research, the number one reason for mortgage loan applications being declined or denied was because of insufficient credit. So let's break this down. I Googled this question and all sorts of information came up. So I am pulling the information from Rocket Mortgage. It's one of the largest, actually the second largest mortgage loan originator in the country. I also found information from nerdwallet.com, LendingTree's website, Forbes Advisor, and Bankrate. The list could go on, but generally speaking, they all kind of had the same information. So let me share with you the number one reason for declines of mortgages when it comes to credit. Even if you had hundreds of thousands of dollars to put down, if you have a credit score that is below the required minimum credit score for FHA, VA, USDA, or conventional mortgages, which are the standard loans that are offered from banks and lending institutions, if you don't hit that minimum, it doesn't matter how much of a down payment you have. And let's break this down. If you needed to have help with down payment, there are down payment assistance programs that are out there from county, city, state, and even some federal programs, but most of them require a minimum credit score. Generally speaking, I see the requirement of 640 or higher. So it goes back to what I've been preaching and teaching all these years is we've got to protect our credit, build good credit and protect it. The second reason for declines or being denied a mortgage loan approval is usually your debt to income ratio. So let's break down credit first, and then we'll talk about the debt to income ratio and what to do about it. Rocket Mortgage classifies it as insufficient credit. So it could be because of your credit score, but it could also be because you don't have the proper trade lines or amount of items reporting on your credit for long enough for approval. In a perfect world, an underwriter or the decision maker would like to see a couple of trade lines. It's anything that reports to your credit report. So that could be a student loan, a car payment, a credit card, an installment loan, anything that reports to your credit for at least 12 months. So that trade line should have a 1-year history and not just payment history, but on-time payment history. NerdWallet actually refers to some of the reporting agencies such as the Home Mortgage Disclosure Act, the HMDA. They report data collected from credit applications. And the information they're referring to was from 2019, but I'm sure 5 years later, it's still quite relevant. And according to this information provided, people were being denied because of a lack of credit history. And then secondarily, it was a high debt to income ratio. And then third was insufficient down payment. So let me break down just to give you an idea of some minimum credit score requirements. The most lenient loan program out there is an FHA loan, and their minimum credit score requirement is 580. I will share this with you. If you've got a 580 credit score, you're not going to get the most favorable terms or the best interest rate available with that credit score. So really aim to have a higher credit score so that you can get a better interest rate. Your credit score impacts your interest rate probably more than anything else, even more than a down payment, the state you live in, or even the property type that you are buying. A conventional mortgage requires a 620 minimum credit score. And I will tell you, there is a tremendous difference on the interest rate and thus your monthly payment if you have a 620 credit score versus a 720 credit score. And because interest rates fluctuate so much, it would be really difficult for me to share it with you in percentages and dollar amounts today, but it can have a tremendous impact. when you are talking about a loan amount in the hundreds of thousands of dollars. So if you're paying a higher interest rate, thus a higher payment, that also then cuts into your buying power. So let's just work backwards from that for a second. Let's say you can afford a $2,500 a month payment. When we're talking about just the principal and interest portion of that payment, that interest rate, the higher it is, the higher that payment goes because there's more of that payment going towards interest. So that means it's going to reduce your buying power or lower your purchase price. In this current real estate market, we really can't afford to go lower on a purchase price because then that property just may literally not exist. So we want your buying power to be as high as possible. And the way you help control that is improving your credit. According to LendingTree, their number one is you have too much debt compared to what you earn. We'll break that down in just a minute. And then their number two is your credit history or score is unacceptable. So you perhaps fall below that 620 or that 580 credit score, depending on what kind of loan program you're looking at. Now, you might be wondering, well, isn't there a loan program out there that if I had a 480 or a 500 credit score, I could get approved for? You could, and it's called hard money. And it's called hard money because, oh my goodness, it is a hard pill to swallow. Hard money is typically in the double digits on the interest rate, and it's very costly to get. So in other words, your closing costs to obtain that loan are tremendously high compared to standard closing costs on a bank or lender issued loan. And also you're talking maybe a 10, 11, 12% interest rate, which is insane when you start multiplying that by hundreds of thousands of dollars being borrowed. So this is not a way you want to go. The easier path is to improve your credit. And if you don't know where to start, friends, I have 120 episodes talking all about the different ways to understand and really take hold of how to improve and understand your credit. According to Forbes.com, in an article called Mortgage Application Denied, Here's What to Do, they list out 21 reasons that a lender may reject your mortgage loan application. And guess what number one is? I know I sound a little boring now at this point, right? Low credit scores. So let's talk about the fastest way to increase your credit profile and credit score. Become an authorized user on somebody else's credit card that has a long-standing credit history, a low balance, and a high limit, and of course, a perfect payment schedule. You're not tapping into their credit. You don't need to ever swipe that credit card. You're only tapping into the credit history of that one credit card, and it now gets added to your credit profile. So again, you are not using their credit card. You're not spending somebody else's money. You're just simply borrowing that portion of their credit profile. And if you have bruised credit, your not so perfect credit profile will have no bearing on their credit profile. So it's not like it cross-contaminates or anything like that. So become an authorized user on somebody else's credit card. Your payment history makes up 35%, and the largest single portion of your credit score algorithm make your payments on time. The reason it is so fundamentally important is because you're proving to other people that you may be asking for them to generously offer you a line of credit or a loan. You're showing them your ability to borrow money and pay it back on time, that you can be a good steward, you can manage your obligations. It also reflects a great attitude towards that agreement. And quite frankly, it's just the right thing to do. Credit inquiries stay on your credit profile for 2 years. So if you don't need a new line of credit, don't apply for things. Now, when you check your own credit, that is a soft inquiry. You are not applying for credit, so that won't affect you. But if you're applying for a credit card, a line of credit, a loan, something along those lines, those inquiries can stay for 2 years, and it will have a negative impact on your credit score. So try to keep those at a minimum. If you have brand new credit established, you might find a dip in your credit score because there's something new that's added and it just doesn't have that longevity or that payment history that proves your ability to make payments on time. So typically somewhere between 6 and 12 months, it really starts improving your score. And after 12 months, it should really have a very positive impact of on-time payments to your credit profile and score. Now, is it possible that you get declined for a mortgage loan even if you have all of these things in working order? It's possible. And that might be because of your debt to income ratio. So if you're taking on too much debt in relationship to your income or what income you can prove, you may not be approved for a mortgage loan because of this. So let me first define DTI, or debt to income ratio, in a manner that hopefully makes some sense here. There are two ratios when we're looking at applying for a mortgage: your housing ratio and your total debt to income ratio. In a perfect world and a good rule of thumb, we want your housing payment to be 1/3 of your gross monthly income if you are a W-2 employee. So what does that look like? If you make $6,000 a month before any deductions, before your taxes, before your 401k contributions, your health insurance, anything like that, if you earn $6,000 a month, we really would love to have your housing payment around $2,000 a month. You might be able to squeeze up to about $2,400, but going above that, you're in mucky waters now, and your housing ratio is going to be higher than what lenders feel comfortable with. In other words, there's not enough other part of your income to go towards the other parts of living, those cost of living bills. Your total debt to income ratio is calculated similarly. It's your housing payment plus anything else that reports on your credit report, such as credit card minimum monthly payments, installment loan payments, your car payment, and also if you are obligated to pay child support or alimony or taxes that are owed on previous tax years to the IRS, those items are also added into your total debt to income ratio. Depending on the mortgage loan will depend on what that DTI, debt to income ratio, can go up to. For FHA and VA loans, I've seen it go up as high as 56% of your gross income. For a conventional mortgage, they really would like to see it somewhere between 45 and 46% as a maximum total debt to income ratio. For instance, $2,700 is 45% of your $6,000 income. So all I did was take $2,700 divided by 6,000, and that gave me 0.45. So I know that equals 45% of your gross income. So let's go back to that first example where your housing payment in a perfect world should be around $2,000. You could probably squeeze up a little bit higher, but let's just say your housing payment is $2,000. Then that would leave $700 towards some other things that report to your credit report, such as a car payment, minimum credit card payments, installment loans, etc. But let's say your car payment and credit card payments equal $1,000. In this case, your debt to income ratio is going to exceed what is acceptable for a conventional mortgage, and you may not qualify. However, you may qualify for an FHA loan because remember I said they usually go up to the mid-50s. So let's go back to that housing payment of $2,000, and let's say you have $1,000 between your minimum credit card payment and your car payment. That would make your total debt to income ratio 50%. So $2,000 in your housing, $1,000 in your car payment and credit card payments, that $3,000 divided by $6,000 is 50%. In this case, you should qualify for an FHA loan as far as their tolerance for debt to income ratio, where you may not for a conventional loan. So let's break down your income for a moment as well. I've talked to thousands of people along the years, and it's never surprising to me how many different ways people get paid and show their income. If you are self-employed, we have to go off of your taxable net income, that adjusted income after your cost of doing business. So let's say you as a self-employed person had made $200,000, but you reflect $150,000 in taxable write-offs. There are a few exceptions to the rule, but generally speaking, we're going to be using $50,000 for your adjusted income, and that's what we have to use for your approval amount. Well, unfortunately, $50,000 in annual income just isn't buying a lot these days. With minimal down payment, you're likely looking at less than $250,000 as a purchase price. And I don't know about you, but in my area of the world, there's just not a lot of homes around $250,000. So let's say you're an independent contractor or a 1099 contractor. you have the ability to write off some things against your income. And again, we're going to have to go off of that adjusted net income as reflected on your credit report. Now, if you're a W-2 employee, it's really simple. We just go off of your salary or hourly. Now, I will tell you this, if you are hourly and your hours appear to be reducing, there's a really good chance that that underwriter may require us to use the income as reflected with your current and lower hours. So that could be a slippery slope. Now, let's say you were ill, got hurt, got COVID, something along the lines where you didn't go to work for the last 2 or 3 weeks. That could be an exception to the rule. We write a letter, maybe we document it somehow, and we can show you're going to be returning to your, say, 40-hour work week. But if you were working 40 hours and now your employer is really working you more like 30 to 32 hours, unfortunately, we've got to go off of the current 30 or 32 hours if it's been pretty consistent year to date. Now, I was working with a nurse, and nurses often work 36-hour work weeks. Well, this particular nurse just moved to a new hospital, and she started off from day one with at least 10 hours of overtime. She'd only been there 4 months. So now the question is, can we qualify her with her 36 hours plus her 10 hours of overtime? Only if she has a history of working overtime hours. Even if she's moved to a different hospital, if she shows that for, say, the last 2 years, she has consistently worked about 10 hours of overtime, and we can get that in writing and evidence it, then we can use the current 10 hours of overtime each week for her qualification. Now, if her previous hospital never allowed any kind of overtime and only paid 36 hours a week, and she's only got 4 months worth of overtime hours, we're really not going to be able to use that as qualifying income because there's not a long enough track record. Now, speaking of track record, that's really important when it comes to showing income from 2 jobs. If you work 2 jobs, whether it's 2 part-time jobs, a part-time full-time, 2 full-time, if you want to use income from 2 employers for both jobs, we have got to show that you've worked at both jobs, or at least had 2 jobs simultaneously for 2 years. Now, that doesn't mean you have to be in the same job for both jobs for 2 years, but it does mean that we have to show 2 years worth of 2 jobs, and then we can use both incomes. Otherwise, we would want to use the higher of the 2 incomes for qualification purposes. Now, let's jump back to the 1099 contractor or self-employed people for just a moment. If you fall into this category, we really want you to be in that role and evidenced by 2 years of tax returns in order to use that income. Now, if you just started as a 1099 last year, but prior to that and in the same line of work you were W-2'd, we can get away with 1 year of 1099. But if you are newly self-employed, then you got to have 2 years worth of tax returns in order to qualify for a standard Fannie Mae or Freddie Mac backed loan. All right, I've thrown a tremendous amount of guidelines at you, but I just wanted to give you a snapshot of not only how credit absolutely affects mortgage loan applications and approvals, but also how debt ratios are calculated and how that can also bite you in the butt. Before I wrap up this episode, I want to talk to those of you who might feel like you're drowning in debt at the moment. Credit card interest rates and balances, for that matter, are at an all-time high. I'm seeing a lot of people opening up new credit cards just to stay afloat, going and getting high interest rate installment loans just to make it through a couple more months. And if that's you, well, let's talk for a moment. You've got to create a plan to get out of this. Interest rates may not be going down anytime soon, and that means that your debt is going to continue to grow. And even though you're making these big monthly payments, you may not be experiencing those balances going down very quickly. Most of your payment is going towards interest, and that is a lousy place to be. It doesn't feel good, doesn't feel productive, and it's not. So what are we going to do about it? The last time I found myself in that position, guys, I went and got a couple extra jobs. That's right. I was working 3 jobs at one time, and I knew it was temporary because, man, that sucked. But I had to get out from underneath it. My car payment was too big for what I was earning. The interest rates and growing credit card balances were just eating away at me, and I was drowning in my own mess. But for all things good and right, please do not go to those credit consolidation companies that are probably sending you a bunch of junk mail right now. See, they have access to some information that you would like to believe is private, but unfortunately, your information is often sold to these third parties. And they'll send you a letter and say, hey, I happen to see you have $20,000 in outstanding credit card debt. We can help restructure that debt, reduce your monthly payment, and get it settled for as little as $300 a month or something along those lines. Friends, it's a trap. This company will start collecting money from you, all the while having you no longer make payments to your creditors. It slaughters your credit profile. It ruins your relationship with the people who extended credit to you. It sticks them now with a collection, and then this company makes money off of you by attempting to settle that debt than less than what is owed. How would you like it if you loaned your neighbor or a friend $100 and then they just stopped making payments to you? They ignored your calls, they wouldn't make eye contact with you, and then the other next door neighbor comes knocking at your door and says, hey, our friend over here wants to know if you'll settle this $100 debt for $60. Like, how would that make you feel? I realize that these are institutions and companies, but we also agreed to some terms that what I was going to borrow, I was going to pay back. And if you don't, it can haunt you for a lot longer than what you think. And in some cases, you can get a 1099 and have to pay federal income tax on some of the debt that was forgiven on your behalf. So now you owe more in federal income taxes come next year. Again, it's a trap, and I'd love to see you not get pulled down into that spiral of disgusting situations with creditors if you can avoid it. So if you're receiving letters from companies like National Debt Relief, shred that letter and do not have a conversation with them. If you are drowning in debt so desperately that you don't see a way out, I want to encourage you to Google credit counselor near me. Now, the top couple of listings are going to be sponsored ads, and it's probably going to be companies just like National Debt Relief. Ignore those and go straight to something that says it's a nonprofit credit counseling agency. Those people will help you restructure your debt and restructure your situation while trying to protect the integrity of your credit profile. If you're unclear about which way to go, or if you have questions, I'm happy to be a resource for you. Feel free to send me an email at questions@creditchristie.com. I love it when I receive an email or a message from my listeners with questions or even feedback. I realize I'm not reaching millions of people, and that's never been the goal. But to know that I've helped you, that I've encouraged you, that's all that matters. And it encourages me when I hear from you. Before I wrap up this episode, I do want to talk to my new realtors in the room. If you are a newer realtor, or if you know somebody who just got their real estate license and would love to crush it in this awesome industry, I have a YouTube channel called The Struggle is Real Estate. And I'm uploading new videos all the time. I also have a subscription-based community just for newer realtors, so you don't have to go at it alone. So come visit me at buildanagent.com. Join our family, join the community, and there's a tremendous amount of resources and help there to launch your business successfully. Your future self thanks you. And if we haven't connected on social media yet, why not? Reach out to me on pretty much any platform at Credit Christie. And until next time, my friends, stay well.
Subscribe now and share with a friend to stay in the loop for new credit content and insider tips to maximize your credit knowledge. And follow Credit Christie on Instagram.